All right, let's get to what's been going on in South Africa with the Reserve Bank releasing its monetary policy report for April, saying that inflation is likely to stay sticky. 8.25% rate may remain unchanged this year. I think that's a 14-year high. March inflation decelerating just a bit to 5.3% to 5.6% in February, but still on the high end of their target range. Who better to discuss this with than Ibukun Omoyeni, Sub-Saharan Africa Economist with Vetiva Capital Management. Ibukun, good morning. You're very welcome. Thanks for joining us. Do you think the Reserve Bank of South Africa is being too cautious by maintaining its stance with rates right now?
Yes, we can say it's cautious. Usually, African emerging markets and frontier markets usually trail the US Fed. And what you are seeing currently is a hold stance across board due to the tensions that are brewing up in the Middle East. Looking at an index, we call it the Global Supply Chain Pressure Index. It shows us the gauge of what is going on with respect to supply chains. And what we've seen is that the supply chain index is below 0 in terms of standard deviations, which means we're not seeing as much pressure as we used to historically. And what that implies is that for the goods inflation, there's a high chance that it's going to fall. For services, due to the disruption, you saw what happened with internet services a while ago, right? It could actually lead to further inflation. But when we look at it overall, right, by the time the US Fed begins to cut interest rates, by the time inflation tensions ease and hopefully these geopolitical tensions ease, we could see rate cuts. But that could be late 2024, maybe Q4, Q1 2025. Due to the current risks that we see.
Now, what's your inflation trajectory for South Africa? So I think the bank is looking at about 5.15% for this year, I think down from 6% or so in 2022. How do you see the inflation trajectory playing out for South Africa?
We think it will average 5%. There's a slight possibility that inflation might decline in Q4, Q3, Q4. Due to, of course, we know that the US election cycle is in view, and you know that you would want to see how that pans out with the global dynamics in the geopolitical space. And what that means is that if that pans out, if the bull case pans out, right, we'll see rate cut. But if you look at the rate cut now, 8.5%, the rate currently is above the inflation rate of 5.3%, and it just shows you that they don't want to preemptive in cutting rate before time. They want to wait and ensure that the pressures are well aligned, and by the time there's more clarity on how the tensions play out, and we think we'll begin to see rate cuts. But it is not overblown like we saw with the Russia-Ukraine crisis, because the GSPI clearly shows us that the risks are not as bloated and is in line with historical averages.
What about the average South African resident? I mean, you know, there's elections coming up. There's been pressure on the bank to cut rates, to reduce borrowing costs, and so on and so forth. So you've got inflation that's still sticky on the high side. You've got borrowing costs at a 14-year high. So what does all this mean for the average South African?
South Africans are facing through a lot right now. I think they are passing through a lot of load shedding, which means that they have scheduled days of power cuts, and that contributes to reduced consumption, also affects investment negatively. And as well, growth is expected to be sticky around 0.6 to 0.7%. But over the medium term, about 2024-2026, it improves about 1.3 to 1.6%. And we think for the consumers, they will just have to manage in this situation, because the South African Reserve Bank cannot reduce rate in an environment where you have inflationary surprises. Like you saw, that inflation rose in February, but fell in March, right? It could rise again in April due to the higher Brent prices. So it has to just stay put, while consumers will have to hold their wallets tight and, just walk through the election. Of course, it could have political consequences, but in terms of economy, the CBN has to be, or the South African Reserve Bank has to be devoid of political pressure. So that's to ensure that rates are kept constant.
Well, I'm glad you mentioned the CBN, because I want to come to Nigeria now. But on the fiscal side, front page of today's This Day newspaper, oil and gas, the attempts to attract about $10 billion into the oil and gas space. So how do you think that can work? You think that's too rosy an expectation?
Of course, you set high targets and you aim to meet them. But I think it's positive in the sense that over the medium term, right, what drives currency is essentially foreign direct investments, especially foreign investments, right? Investment, your inflation relative to your trade partners, and the rate of growth. And if you want to speed up growth, you need to chase foreign direct investment. I mean, I've already seen that play out also in the banking sector with the recapitalization move. It's also a chase for indirect investment. So over time, that could actually attract and improve foreign inflows into the Nigerian economy and bring patient capital that could actually catalyze development. That will translate into better development outcomes in terms of GDP per capita, in terms of our improved life expectancy and all that. So we need those investments to come in, and I think the federal government is going in the right direction, because these are the moves that are necessary to unlock, especially when you have a refinery on board, 60,000 barrels. It's the largest refinery of its kind, and even in the world, right? And when you have domestic refineries and you are producing oil within your country, the oil you produce and you sell to the refinery within your country is not subject to OPEC quota. So that means that 650,000 barrels, if a Nigerian oil firm sells 650,000 barrels, just hypothetically, to Dangote refinery, and let's say our quota is 1.5, we can do close to 2.1 million barrels per day, and that's the advantage when it comes to refining. So I think it's a good one that we are chasing investment. We think oil will not go anytime soon, even despite the drive for electronic vehicles and all that. We think oil will still remain with us for a while.
So this is now linked to the dollar, of course, and our FX earnings for Nigeria, all this oil chatter. What have you made of the movement in the Naira over the past month or so?
It has been quite volatile, right? But when we look at the Naira, it's actually following the fundamental measures, right? So if we look at last year, interest rates were averaging about 6 to 7%, treasury bill rate. And this year we saw a significant improvement. Beyond the rate hike, we also saw money market rates improve. So around 18 to, at times, also 21%, 22%. And when you look at the true yield, when you want to look at pricing at the discount, it made about 25%, right? And that yield made the carry trade attractive for Nigeria again. Foreign investors started to buy, and a lot of them came in at the 1.6 to 1.8 range. And just last week or 2 weeks ago, we saw, of course, huge profit taking, because if you came in at 1,800, you take out your dollars at 1,200 or 1,000 naira, that's about over 30 or 40% currency gain, right? Aside the gain from the interest rate. So it just makes sense that some probably take profit, but I think that foreign portfolio investors will still be looking at Nigeria, because when you look at the prospects, right, the Dangote refinery is coming on stream, which will take out a lot of oil import. You look at the fact that there will be $1 billion inflow in May from African Bank, 1 billion in June from the Eurobond. There's also 2.2 billion from the World Bank. That's about $4 billion in inflow. So by the time all this news, all this news materializes, right, it's going to reduce the depreciatory pressure on the Naira, right, and that's going to see Naira gain or stabilize by the medium term, right. What we are seeing now is normal, right, to have fluctuations in the currency, and that's why we think that the CBN will continue to hike when it comes to the May MPC. We've seen inflation accelerate at a record pace, right? Well, a key measure I look at is the month-on-month inflation, 3.3% for 2 consecutive months. It shows that there is a pressure with food prices, right? And if that pressure is abates, possibly because of the release of fertilizers from the CBN to the Ministry of Agriculture, or as a result of possible lower fuel prices as a result of the refineries selling to local marketers, this could actually abate inflation over the near to medium term, and that would add to the positive outlook. But we think that given that shock that we saw with the inflation numbers, we expect that inflation might begin to decline possibly around Q3. Initially, we had the Q2 estimate, but given the recent shocks, we think Q3 will be the right time. And by the time inflation begins to decline, right, by the time inflation declines, it also adds to the gains in the Naira, because lower inflation relative to your trade partners, higher interest rates relative to your trade partners, improved growth relative to your trade partners, those are the parameters that would pave way for currency gains. And we think FPIs will still be watching Nigeria, and once the carry trade becomes attractive again, they will surely ape in, and that's positive for Nigeria within the short term, because monetary policy is allowed to intervene in the short term in the foreign exchange market.
Hey, Ibukun, it's always a pleasure discussing the Nigerian economy and also the rest of Africa with you. We thank you for joining us. Ibukun Omoyeni, Sub-Saharan African Economist with Vetiva Capital Management Ltd. Thanks for your time. Appreciate it.